Welcome to This Explainer. Today, we're cutting right through all the Wall Street hype and diving straight into the hard data to see if this AI boom is actually real. I am super excited to guide you through this because, well, if you've been following the markets, you know there is a ton of noise out there right now. We're going to bypass all that and look at the numbers that actually matter.
So cast your mind back to mid-2026. Markets were absolutely terrified we were facing another dot-com crash. Seriously, investors were totally panicking, worried that companies were just throwing money at AI without seeing any real financial returns. But we're going to look at how one specific hardware company's numbers completely flipped investor psychology, literally overnight.
To answer that, here's how we're breaking it down today. 1. Wall Street's AI panic. 2. Micron's profit explosion. 3. The hardware bottleneck. 4. Locking in the future. And finally, 5. The threat of overexpansion. Let's get right into it.
Part 1. Wall Street's AI panic.
Right, so there was this massive disconnect playing out in real time. On one side, you had the fear. Investors were practically convinced we were in a massive AI bubble, and that fear drove the NASDAQ 100 down over 3% in a single day. People were drawing direct parallels to the year 2000. But on the flip side, you had the reality. Away from the noisy trading floors, the world's biggest tech giants were quietly and aggressively buying up massive amounts of physical AI infrastructure.
And that stark contrast brings us to the absolute most important question for anyone trying to navigate this space. Are we just building castles in the sky here? Or is there real, concrete money being made?
Which brings us to Part 2. Micron's profit explosion. Talk about a staggering leap. Quarterly revenue jumped from $9.3 billion in 2025 all the way up to $41.46 billion in 2026. And remember, this isn't some hopeful pie-in-the-sky forecast. This is actual cash coming through the door. It brilliantly illustrates undeniable industrial demand. Tech companies were basically buying hardware as fast as humanly possible.
But wait, here is the real kicker. Revenue is great, sure, but profits, they exploded by 15 times. That's right, 15x. Micron's net income surged from $1.89 billion up to $28.24 billion in just one single year. Just let that sink in for a second. This wasn't some abstract software hype. This was a manufacturing company literally printing money at an unprecedented scale.
So how does that happen? Let's look at Part 3, the hardware bottleneck.
It all really comes down to a literal, physical traffic jam involving high bandwidth memory, or HBM for short. HBM consists of these specialized, super-fast computer memory chips that have to be physically stacked on top of each other. Think of it like a microscopic, incredibly high-stakes game of Jenga. These chips are absolutely essential for AI to process massive amounts of data quickly. You can't just print them out on a whim. They require incredibly complex, multi-layer packaging that takes a really long time to complete. So let's step through how this creates an economic perfect storm. Step 1. Tech companies demand massive amounts of HBM. Step 2. Because that complex physical stacking takes so much time, factories hit a physical packaging bottleneck. They simply cannot increase production instantly. Step 3. Demand completely outstrips the available supply, causing prices to absolutely skyrocket. And finally, Step 4. Because the cost to actually make each chip stays pretty stable while the selling price goes through the roof, Micron's gross profit margin hits an astronomical 85%.
And the crazy part? The effect didn't just stop at AI. The pricing power in the memory market got so strong that even standard memory chips, your traditional DRAM and NAND flash used in everyday servers, computers, and smartphones, saw their prices jump as well. It created this huge halo effect that supercharged overall manufacturing profits across their entire product line.
Moving on to Part 4, locking in the future.
Micron's executives were super smart here. They moved away from relying on short-term spot sales. Instead, they locked the biggest tech giants into binding take-or-pay strategic agreements. Basically, this means a customer legally promises to buy a set amount of microchips, and if they suddenly change their mind, tough luck. They have to pay a massive penalty fee anyway.
And this wasn't just some casual handshake deal. Customers put up a massive $22 billion in deposits and cash commitments just to secure their spot in line for these chips. For Wall Street analysts, this was the concrete, undeniable proof they needed. Tech giants are firmly locked into buying physical hardware for years to come. It wasn't speculation anymore. It was committed, cold hard cash.
When financial analysts saw those actual corporate profit margins combined with binding cash commitments, the ripple effects were just huge. First off, it provided this predictable cash flow that allowed Micron to pay off billions in debt, significantly lowering their financial risk. Second, it enabled them to confidently fund multi-billion-dollar factory expansions. And third, it stopped the tech panic right in its tracks, sparking a massive rally across both US and Asian technology markets.
But what goes up must come down, right? That brings us to Part 5, Threat of Overexpansion.
We really have to remember that this massive pricing premium, it only exists because of temporary factory bottlenecks. It's essentially an artificial shortage. Once factories resolve those physical issues with stacking and packaging the chips, that unique pricing premium is going to disappear. And on top of that, Micron faces sudden operational risk from extensive, ongoing patent and product litigation, covering a huge chunk of its standard DRAM and NAND products.
Now here's where the real danger lies on the timeline. To stay competitive and meet this totally surging demand, Micron, along with rivals like Samsung and SK Hynix, are spending incredibly heavily. Micron alone is committing an estimated $27 billion to capital expenditures in 2026. By late 2026 and into 2027, all of these massive new factories are going to finish construction and open their doors at the exact same time.
So here's the absolute crucial point. If market demand for AI infrastructure drops even slightly, or if software monetization doesn't catch up to this massive hardware spending, all that heavy capital expenditure suddenly becomes a huge financial burden. The sudden flood of new chips from all these new factories hitting the market at once could completely crash prices, entirely wiping out those beautiful 85% gross margins we talked about. Which leaves us with this final critical thought to take away from our explainer today. The numbers show the AI infrastructure build-out is absolutely real right now, backed by massive corporate commitments. But when those factory doors finally open in 2027 and that great supply bottleneck totally vanishes, will the AI boom hold steady and actually consume all those new chips, or is that when the real bubble bursts? Thank you so much for joining me to unpack this data, and I'll catch you in the next one.